It's time now for our Muni moment. And as credit research becomes increasingly important, analysts are using all sorts of novel methods to gain a better understanding of Muni risks. And that includes flying drones over suburban sprawl, also participating in breakfast chats at local diners. This all sounds so mysterious. Let's get more insight now and bring in Rob Amodeo, head of municipals for Western Asset Management. So what kind of surveillance techniques are you using at Western, Rob?
Well, like most firms, we're looking to use the new technologies, the machine learning algorithms. Essentially, if you want to summarize it in kind of an oversimplified manner, is we want to collect, collate, and analyze information in a manner that gives us an information advantage. Now, in financial markets, you kind of raise your eyebrow and say, how can that be done? Within the municipal bond market, it's opaque, it's inefficient, it's illiquid, it's over the counter, there's poor disclosure, although disclosure is improving. If you have the ability to collect that information faster and interpret it faster than your competition, that's where the advantages are, and we've been increasing use of really advanced technology for the last handful of years.
Well, and really this is all due diligence, right? I mean, if you want to know how a factory is doing, you might want to drive past the factory at one point or another. So tell us, where have you found some pockets of value that maybe you didn't know about before, geographically and also infrastructurally or whatever it may be? Yeah,
so depending on the region, you have to really look to the diversity of the economy, the level of education, household income, good old-fashioned fixed income analysis. Yeah, I think where there can be misleading information is where you're interpreting a large pool of data, new data that you haven't looked at in the past. So I think you really want to rely on a good old-fashioned, the element of human judgment, the professional credit surveillance that we have at Western Asset Management, and incorporate this new technology into that process. So I don't think you want to overly rely on, geospatial surveillance for public finance specifically, but I think you do want to use that as an opportunity to cast a wider net, to look across a wider spectrum of the marketplace, to look for opportunities where prices are kind of misaligned versus the fundamentals, and try to identify trends before your competition.
Are you seeing a lot of that right now, meaning that mismatch?
Yeah, I think now in today's marketplace, not so much, because the valuations reflect a lot of good news.
Yeah.
We were talking about that just a few seconds ago. I think the marketplace is good balance between supply and demand. The fundamentals are rock solid. Tax receipts, although beginning to plateau a bit, have been rock steady, and that information is priced in. So everything is kind of fair value to full value in a marketplace. I think where we're seeing the real opportunities is in the structure, whether it's callable, non-callable, the coupon stack, whether you're moving up and down, and then the placement of the curve. The municipal bond curve is unique right now. We've never seen an inverted municipal curve, and yet the valuations are full. So it's the complexity there. How do you take advantage of that? And I think it's time to look at that opportunity.
What about investor appetite, though? I mean, there's been a lot of discussion, and we were speaking with our previous guests over at Newberg or Berman about the competition, I guess, for instruments that give you the yield and return that investors are looking for. Where do munis fit in?
Yeah, the dynamics are changing. Now, if you look at the size of the market, it's unchanged, and that's unique within the fixed income world. Corporates are 65% larger. Treasury is obviously much larger than that. Municipals, $4 trillion, and that's unchanged since 2010. The dynamics of who's buying municipals has changed with the drop in the corporate tax rate. So the demand from property and casualty insurance companies is non-existent. They move to taxables. The inventories of broker-dealers are down. So we're really relying on the retail investor, and that's something, obviously there could be dramatic swings coming out of that retail investor base.